Hi, today we're going to talk about monetary policy in detail. So, there are various tools to implement monetary policy by central bank. First one is policy rate. So, it's the rate at which banks can borrow funds from the central bank, Fed in United States, European Central Bank called ECB in Europe. So, in Europe, it's called refinancing rate. In Britain, it's the repo rate, repurchase rate is being used as a policy rate. In United States, it's called a federal fund rate. So there's other way to control the money supply or to influence the money supply is a reserve requirement. So we did talk about it earlier. It's a percentage of deposit the bank should always kept in the reserve. By increasing the reserve requirement, bank can effectively decrease the money supply because they have to have this amount of fund always in reserve so that they can meet any withdrawal requirements. Open market operation, the central bank can involve in buying and selling securities, and it's important to keep the federal funds rate or repo rate or refinancing rate at the target rate. So there are qualities of effective central bank. So central bank should be independent. It should not work as an influence of any government pressure. All its operations should be independent, and it should work towards its objective like full employment, have a stable inflation, and have a durable long-term interest rate. So that's one of the good quality of effective central bank if it's independent from any government pressure. It's credible like what policies and the inflation target it's setting for economy, and the economy actual inflation meets the expected inflation, which adds to the central bank credibility. Transparency, the policies and money supply or all the policy rate reserve requirement, they should be transparent and they should be communicated well in advance so that people can act upon it in advance. Now we move to the third point: inflation, interest rate, and exchange rate targeting. So there's a relation between all these three rates. So most countries can affect their interest rate by increasing or decreasing the money supply. We talked about it in previous section. Inflation targeting, like most economies in the world, they have a predetermined set of inflation, like they want to keep it 2%. And why 2%, why not 0%? Because 0% is, it's like we are touching at a very dangerous level, because deflation, by going into negative we go into deflation, and deflation is much more harmful for an economy than inflation. So by keeping 2% or plus minus 1%, then 2%, and that's the most economy they keep their inflation target. While in US doesn't follow the inflation target, and rather than the approach is more about objective based, like having the full employment and by keeping the price level stable. That those are the objective which monetary policy are based on. So but like developing economy, or other countries, they do follow the inflation target. Exchange rate targeting, especially the developing country, instead of having their own monetary policy, they kind of conform to the monetary policy for which they are pegging their exchange rate. So most of the time it's dollar, so they want to keep the exchange rate like kind of stable or constant to dollar. So to do that, they have to keep on changing, they have to juggle their money supply, or they have to change their interest rate so that their exchange rate remains very much stable. Okay, let's go to next section. Uh, okay, so now here we're gonna talk about expansion and contractionary money policy. We did talk about it earlier in expansionary. Apologies for moving it up and down. So in expansionary and contractionary money policy, uh, how do we decide whether the policy is expansionary or monetary policy? So we here we're talking about the target rate for which we talked about the policy rate, which is our target rate, for which we think our economy is stable. So our actual rate, or we can say neutral interest rate, is is a is a combination, or is a sum of real trend rate and inflation target. So the real trend rate is we can say is the economy's long term sustainable growth rate, which some economy wants to maintain. Could be 3% for developed country. For developing country like India and China, it could be 6%, 7%. So that kind of real trend rate which the country have in their mind, plus the inflation target, which maybe plus 1 or 2% above and beyond that. So when the policy rate uh, which we talked about earlier is above this neutral rate, then we can say that our monetary policy is in expansionary mode or in contractionary mode. So based on policy rate, which is which we talked about in US, we have federal fund rate, and other country we has a repurchase or repo rate for overnight deposit. So based on so that's a kind of a short term rate, and this is a kind of a long term rate. So when this short term rate goes up, so we want to contract the money supply. When we short term trade goes down, like we want to encourage deposit, we want to increase the money supply. So that's kind of a expansionary monetary policy. However, we theoretically we say monetary policy should work, but in reality it takes time to be effective, or there are certain limitations. So one of the limitations which we mentioned here is called a liquidity trap. So when central bank by controlling the money supply brings down the interest rate, but still uh, the aggregate demand doesn't go up, and the reason doesn't go up because consumer think they should keep their funds in saving, and they don't do the investment the way they should be doing it. So in this case we kind of have a more money supply, and still we're not able to accelerate the aggregate demand. So this kind of situation is kind of a deflation, or expansionary money supply. It's called a liquidity trap. So another example, like a short-term interest rate can be easily affected, but the long-term interest rate may not be in sync in the short-term interest rate, because long-term interest rate have a inflation amount already factored into it, and the bonds market, they behave based on a long-term interest rate. So what I'm trying to say here, this monetary policy may well affect the short-term rate but may not affect the long-term rate. So these are few limitations of monetary policy, even though it sounds like it should be very effective, but in reality, due to these limitations, it may not be very effective. Thank you.